In 2025, a new tax law handed real estate investors something they were about to lose for good. If you bought a property and missed it, you left a six-figure deduction on the table. And if you're a high-income earner buying real estate, this is the single most important change you need to understand before you make your next purchase. I'm Ryan Carrier. I'm a CPA who helps high-income earners use real estate tax strategies to lower their tax bill. So let me show you what changed, and then I'll walk you through a real client's numbers because the math is honestly pretty wild. So here we go. So here's the backstory. Bonus depreciation lets you take a huge amount of depreciation in year one instead of spreading it out over several decades. But under the 2017 Tax Cuts and Jobs Act, it was phasing down. We had 100% bonus depreciation from the end of 2017 through all of 2022. But then it started to phase down, so 2023 was going to be 80%, 2024 was going to be 60%, 2025 was going to be 40%, 2026 is going to be 20%, and 2027 was going to be 0%, and then 0% moving forward. So if you had bought a property in 2025, you were looking at potentially a 40% bonus depreciation maximum. And by 2027, if you bought a property then, it was going to be completely gone. But then, on July 4th, 2025, the One Big Beautiful Bill Act was passed and signed into law. And it did something pretty big. It didn't just extend the 40% bonus depreciation. It made 100% bonus depreciation now in effect for properties that are acquired and placed in service after January 19th, 2025 and moving forward. So just sit with that for a second. The rate was going to be 40%, where you were expecting 20% the next year or 0% in 2027, and all of a sudden you've got 100% bonus depreciation for years moving forward permanently. So we went from a potential 40% bonus depreciation to 100%. That's a 2.5x, 2.5 times multiple in additional bonus depreciation that now can be taken. So you could have the same property, same investors, same asset class, but now you can get 2.5 more times in bonus depreciation in that first year, purely because of the new tax law change. Now, yes, one thing to keep in mind, the building structure, the 27.5 and the 39-year property, those are not getting bonus depreciated, nothing changes there. But yes, the 5, 7, 15-year property, all of that is now back to having 100% bonus depreciation, and it's not phasing down. So how do you figure out the 5-year, the 7-year, the 15-year property? Well, in comes a cost segregation study. A qualified engineer is going to take the purchase that you have, figure out the different components that fall into the 5-year, the 15-year, for example, and help you understand how much can you take in accelerated depreciation. And whatever falls into the 5 and the 15-year cost from your purchase price, now you can take 100% bonus depreciation, again, on anything you acquired and placed in service after January 19th, 2025. So if you're watching this in 2026, 2027, those assets are qualified property, can get 100% bonus depreciation for yourself. So now let me show you what was happening for a real client of mine and how impactful this was for him. All right, so before I walk through a real example, this is the type of stuff I talk through with my clients on how to use these things like cost segregation studies, bonus depreciation, when they acquired the property, how much was it for, in order to help them use real estate tax strategies most effectively to meet their financial goals by offsetting some of their taxes. And if you're a high-income earner looking to deploy capital into real estate or other investments and you're looking for tax savings, I'd love to speak with you. You can book a call with me in the description below. Okay, so now let's talk about the real client example that I had. I've rounded some of the numbers here and taken out anything that could be personally identifiable to them, but ultimately what we have is an executive at a large tech company that probably all of you have heard of. In 2025, their total compensation, including their W-2s, capital gains, things like that, was going to be over $2 million. Now, after the One Big Beautiful Bill had passed and 100% bonus depreciation came back into play, he bought his first short-term rental. And that property he purchased for over $2 million in Tennessee. He ran it as a short-term rental with an average stay less than 7 and materially participated in that property in 2025. That property alone gave him over $600,000 of first-year accelerated depreciation, thanks to now getting 100% bonus depreciation because he acquired and placed the property in service after January 19th, 2025. Had he acquired that same property without the accelerated depreciation coming back to 100%, he would be looking at more like a $240,000 in accelerated depreciation. A huge benefit in this client situation. The total tax loss that he had from that property that year was $620,000, obviously $600,000 coming from accelerated depreciation alone, with the other $20,000 just coming from the first year short-term rental, a $20,000 net operating loss, which is not too uncommon for your very first year as you get things up and running and as you get more guests, reviews, things like that. So here's the part that most high income earners get wrong though. Normally rental losses are passive. They can only offset other passive income. Think not your W-2 income, that's non-passive. To get around that, you'd have to meet real estate professional status, getting 750 hours and more than half your time in a real property trade or business. And if you have a $2 million income and most of that is from a W-2 employment, yeah, good luck trying to clear that, especially if your spouse is also working full-time. But the short-term rental strategy is different. When the average stay per guest is 7 days or less, on average for the full year, now it's not considered a rental activity. So now you just need to materially participate, and you've completely bypassed the real estate professional status need for that strategy, and now this can become non-passive, which means now it can offset your W-2 income. And that's the huge unlock. You don't need the 750 hours, no more half your time. It just offsets because you meet the 7 days and the material participation. Now it can offset your W-2. But here's the part where a lot of videos online are gonna get this wrong or overinflate it. You can't offset unlimited income, especially as a W-2 employee. And what I'm talking about is the excess business loss limitations. This is under section 461. That talks about how much non-business losses can be used to offset non-business income, like wages, for example. For 2025, that cap was $626,000 for married filing joint couples. And if you remember the loss that I just told you about that he took, he got a $620,000 loss total. That was $6,000 away from being capped. And that was part of the plan, not by accident. I had talked to him proactively about the excess business loss limitations, about what would be there. There would be this limitation if the cost segregation study became very, very, very high on the amount of bonus depreciation. And he was well expecting exactly to get right around that amount, but knowing that even the carry forward into next year would be carried forward as a net operating loss, which would just be carried forward and not lost forever. But we had sized the deduction in a way that we could use the full deduction in 2025 to offset as much as humanly possible across his W-2 income. And I did the math for him. That saved him about $245,000 in taxes across federal and state. And notice what I did not say. I did not say he paid zero tax. This isn't a magic trick to pay nothing video. But what this is a 1 year, one property, $245,000 back in his pocket. Now, I have two quick caveats. One is the state taxes. Most states that have income tax, they don't conform to bonus depreciation. So most of that $245,000 that I mentioned in tax savings is mostly federal. You got a little bit of state tax deductions. And the other thing is timing. When he sells, there will be depreciation recapture, but we have a plan for that. And I'll touch on that in a little bit or in other videos you can see. But I'm not going to talk about that now, but I won't pretend that it's not there. Okay, so that was my client's example. So if you're watching this, you might be like, great, now where do I sign? But just slow down for a second. This strategy is very powerful, and I've seen it played out hundreds of times, but it's the type of strategy that can blow up in your face if you do it incorrectly. Let me give you 3 things that determine if this actually works for you. First is just knowing that things have changed with the excess business loss limitations. In 2025, it was $626,000, but with the new tax bill, it reduced the excess business loss limitations to now for 2026 married filing joint couples, it's $512,000 you can use in 2026. So had my client done that in 2026 with those same exact amount of deductions of $620,000, he would have $108,000 carry forward into the next year. Doesn't get lost, but not as ideal as using it all in the current year. Second is the placed in service timing. The bonus depreciation rate is determined based on the year it's placed in service, not the year you decide to buy, not the year you decide to do a cost segregation study. You can wait until after the end of the year. That's a common question I get. In order to do the short-term rental strategy specifically, you have to have a couple stays before the end of the year and have this placed in service, which you would in order to even have the stays that you need. And last thing on timing, depending on when you're watching this, at the beginning of the year or the end of the year, the closer we get to the end of the year, the more difficult this is going to get because you need to get material participation time into the property. You can imagine how difficult it's going to be if you close on a property in December compared to closing on a property in July. But 3 things determine whether this actually holds up under the IRS scrutiny. Material participation has to be real and documented with a time log. That's a big thing I help my clients with, to determine what counts for material participation and what doesn't, and reviewing those time logs on a regular basis. Also, the 7-day average has to be real. You have to have a couple stays before the end of the year, like I mentioned, and you should document that you have the average to be less than 7. That's especially important if you had any stays over the course of the year that were above 7. Because if you get audited and you can't show a time log or you can't show that the average day is less than 7, you're going to lose the audit. And basically they're going to take that non-passive loss that you took to offset your W-2 and they're going to make it passive. And if it's passive, it's just going to be suspended. You'll then have a lot of tax due as well as penalties and interest as well. This strategy really lives or dies on documentation as well as any other strategy you might take on your tax return. And lastly, let's talk about depreciation recapture again. When you sell, depreciation recapture is going to come back in the form of income. So part of this could potentially be a deferral depending on when and how you sell. The way you turn deferral into permanent savings is through a 1031 exchange, or you hold it until your heirs get a step up in basis until you're passing. And this strategy can work really beautifully for the right person, but be terrible for the wrong people. So here's a quick check for you. This is potentially a good fit for you if you've got a high active income, meaning a big W-2 or profitable business. You like real estate and you're planning to buy real estate anyway, and you're genuinely ready and willing to put in the time to achieve material participation, specifically in a short-term rental. But this is not for you if you're looking for a way to never touch the property. You want a long-term rental. Obviously, real estate professional status would apply here. That's why I'm mentioning that. Or you're chasing deductions with assets and investments that you don't want to own anyway. The tax tail should never wag the investment dog. A bad property, a bad investment with great tax savings is still a bad investment. So if you're a high-income earner and that first description sounds like you, this is exactly the type of planning I do with my clients at Carrier Tax Consulting. If you're interested, you can find the link to book a call with me in the description. We'll figure out if it's a fit, and if it's not, I'll let you know. And do me a favor, if you liked this video and you found it valuable, please do subscribe to my YouTube channel. And a quick reminder, this is all educational, no tax advice. Please speak with your own tax professional. All right, I'll see you in the next video.